Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about business partnerships. They all start off well, otherwise they wouldn't start, I guess, but not all of them end up working well. Now, everyone starts with good intentions, shared vision. Maybe you've had a personal relationship with the person in terms of like friendship, or you've worked with them before. Maybe you've got complementary skills, and they probably all go through a honeymoon phase. But at some point in time, you might find some friction, and that's what we want to talk about today, is how to navigate those changes and how to know which solvable problems and which problems might be best, or might be a signal that you both need to go your separate ways. So Mina, let's talk about some common pitfalls then.
So I'll walk through some of the main sort of reasons that we find that partnerships fail or business partnerships fail. And the first most common one is probably around just misaligned values and goals. So like things such as when one partner might prioritize profits or how the P&L looks and the other might prioritize business purpose and what they're trying to achieve. This could be things like client or customer satisfaction, employee satisfaction, whereas one partner just wouldn't care for the outcome, but more so just dollars in the bank. Another reason could be around sort of different long-term visions. One wants to grow without having the right sort of foundation in their business, whereas the other one might want stability, and this can often happen when there's a disparity in age between partners as well. Values can clash as well, and then people can sort of buckle under pressure. The next reason is around communication. Obviously, poor communication, avoiding sort of the tough conversations about money, roles, or expectations can lead to sort of the partnership being broken down. And especially if you're not willing to have that conversation, that's a really big indicator that your partnership isn't right. There could also be an unequal contribution where one partner sort of feels they're doing more than the other partner, or perhaps the partners aren't talking about what they're doing altogether. So one might think that they're actually doing more than the other, but it might not actually be the case. So there could be a lack of transparency around effort, around sort of performance or financial contribution, which will lead to resentment and a breakdown of trust. Also, could be sort of a breakdown or undefined sort of roles and responsibilities. So overlapping duties can sort of create confusion and conflict. Sort of too many cooks in the kitchen, where that saying sort of comes into play. So there's no sort of clear decision-making process. Everyone's trying to do or go about their own ways. And when everyone sort of thinks they're in charge, no one really is. There could be things around money and control issues. So differing attitudes around spending, reinvestment, or taking profit. Some owners might, for example, prefer to sort of take money as soon as it comes in from the business, whereas one partner might want to reinvest in the business and grow the business further. There might be sort of emotional attachment around financial decisions, and this can particularly come into play if one partner has a better financial standing than the other. There could be a lack of legal and structural clarity. So, anytime that we have a client that wants to go into a business partnership, we always recommend a partnership agreement that clearly stipulates sort of exit clauses, how to deal with conflict and the mediation processes. However, we find that still till this day, unfortunately, there's a lot of handshake deals that just later turn into sort of legal nightmares. So Stuart, in your experience, what are some of the telltale signs of, a partnership being in trouble?
I think the first sign, Mina, is that, decision-making becomes a bit of a battleground, as in there's always friction in the decision-making. I think it's a sign that, maybe not both partners are kind of on the same page or heading in the same direction. And so where there's a lot of friction around that decision-making when there shouldn't be, even with small decisions, that can be a bit of a red flag. Disengagement, so unwillingness to collaborate, to communicate, to share information, to contribute towards decision making also can be a bit of a sign. So that's really when one partner kind of withdraws. Now, sometimes partnerships, you might have a silent financial partner, if you like. So that's not the case in this situation. Of course, if that partner's always not necessarily been engaged in the day-to-day of the business, I'm not really talking about that. But where you have two people working in the business and one becomes disengaged. Transparency around decision making or financials, if that starts to disappear, so fewer updates, reluctance around provision of financial information, transparency, that sort of stuff, that can be sometimes a bit of a red flag. Well, probably always a red flag if it's lack of transparency around financials. Again, just difficult working relationship. I think, a business partnership isn't that much different to, other relationships we have in our life, whether it's with friends or, our life partner or those sorts of things. We can always feel if it's not, if the other person isn't particularly happy. And, if the common goal diverges. So, we enter into a business, we tend to have a common goal. We want to build a certain business with a certain reputation, help certain people in a certain way, or drive a certain financial benefit. And we're kind of all on the same page. But if it starts to deviate, one person wants to go in this direction, the other person wants to go another direction, that can be also a bit of a red flag as well. So, Mena, how do we go about preventing? Maybe you can talk about how we go about preventing a partnership from failing, and maybe, Mena, we can talk about our own partnership. Of course, we've had a business partnership for 10 years. I'd like to say, I don't know if you would agree, but I'd like to say it's been a really productive and enjoyable relationship where we really haven't had any major friction. Well, I can't really think of any major friction. So maybe we can share our own experiences of what's contributed to a successful business relationship, touch wood, so far.
Yeah, definitely. And I think what we did from the start is we defined what each of one of our roles was going to be and who's responsible for what and what strengths we can lean on each other for. And what we did is especially, and I touched on this before, is around using external advice early. You need to get legal advice. You need to establish a partnership agreement, whether it be a shareholder agreement, unit holder agreement, whatever you want to call it. But it needs to be established from the start that clearly defines roles, responsibilities, and how to sort of deal with any potential conflict that might come up. You sort of got to plan for the end at the beginning. You need to have an exit strategy before you actually need it. Now, of course, we don't always go into sort of a partnership thinking that, it's all going to be doom and gloom and we've got to, it's going to be the worst thing ever. But we also need to plan for that situation. So, what worked well for Stuart and I would like to believe, is that we agree on values, not just a vision. We have the same set of values. We got the same set of goals, that what we want to achieve for our clients. We want the business to grow based on not just financial metrics, but on the fact that we want our clients to grow with us. So, from their wealth perspective, we want to help them on multiple avenues, on multiple sort of facets of the business. And then we set up the right structures between not only legal agreements, but around profit splits. And when and how can we take profit out of the business? What does that look like? When do we need to reinvest in the business? And what the framework is around that sort of decision-making process. So communication as well was a big piece for us. Till this day, we meet up at least once a week where we talk about the business and what we should be doing and what we're working on. And it ensures that we're sort of working on the same things and we're not misaligned in our overall goals and what we're trying to achieve for the business.
I read a quote by Warren Buffett on the weekend and it sort of made me giggle. He goes, the quote, something along the lines of, I never want to do business with someone where I need a 50-page agreement. I like to do business with a person where a one-page agreement will do, because with a person where I need a 50-page agreement, I'll always wonder whether I needed 51 pages. And it's really interesting. It goes back to what Mena was saying around shared values and vision and so forth. But I think a successful business partnership is really the combination of three factors, which is trust, respect, and communication. And I think it's true with all relationships, again, whether they're personal relationships or friendships, these sorts of things. The foundation that we must respect each other is something that Mena and I believe in strongly. We trust each other in terms of that we're going to do what we're going to do. We're always going to bring our best work, all those sorts of things. And then just open communication. If we've ever had, if we ever feel like this is not what we expected, then we clarify expectations and we do it really really quickly, which is an incredibly important thing. I've had a completely different experience when I first left my job at Deloitte. I started a business, originally started what was Pro Solution, it's what became Pro Solution, I should say, with a friend. But I quickly worked out within only about 2 or 3 months that it was never going to work. We were probably the antithesis of what I just explained in terms of all those attributes, and called it early. And obviously, who knows how it would have worked out, but I probably wouldn't have worked out as well as it has at Pro Solution. So I think from these perspectives, you've really got to go back to those core values and really ask yourself, is it the person? Because people don't really change. So if someone is, lazy and not doing their fair share of the work, then a lazy person's probably going to be lazy in all aspects of their lives. And you can't really change that. You can try, and it's always very hard work to get a lazy person to not be lazy. It takes a lot of effort. And so I think it's about being really honest and upfront with, what is contributing to the problems. Are these solvable issues, or is it just a case of these two people, you and the other person or people, just shouldn't be working together? But hopefully that's, and that's why I was saying I wanted to sort of add a little bit of that sort of softer style context in terms of, the shareholder agreement, all those sorts of things. They're important, and we did all those things, Mena and I, but they're not the ingredients. That's not what's going to make it successful. That's really just prudent business management. What makes it successful is everyone approaching and treating the relationship with a good level of respect. Okay, until next week, bye for now.